This is the front page of a New York Times paper from 1929. It includes a story about a huge piece of tariff legislation called the Smoot-Hawley Tariff Bill. It wasn't passed as law yet, but it was getting closer, and on that date, a suggested amendment that would reduce the import tax on calcium carbide was rejected. 16 senators who were previously against tariffs flipped and voted in favor of higher tariffs. The movement to heavily restrict global trade was gaining momentum in Congress. But the most notable element here is exactly when this story broke. Thursday, October 24, 1929. The day now referred to as Black Thursday. The first major day of the biggest stock market decline in US history, and the beginning of the Great Depression. This article on that specific day could be a coincidence, but it was enough to send me down another rabbit hole to explore whether tariff sentiment caused the 1929 stock market crash, and more importantly, what role these policies played in turning a financial crisis into a multi-year depression. Just before we continue, I want to briefly tell you about the sponsor of today's video. You all know investing.com, but I want to tell you about Investing Pro, the company's flagship subscription product that helps retail investors find stocks others can't. Create personalized watch lists to track your favorite stocks and get an easy overview of stock health and valuation. The fair value calculator, for example, is based on fundamental metrics and gives you a clear buy or sell indication on a traffic light colored scale. The Ideas tab lets you learn and copy strategies from investing legends like Warren Buffett, even adding their holdings to a watch list with a single click, a feature you can actually try right now for free. You can also access their Pro Picks AI feature. Browse their catalog of algorithmically selected or AI refined portfolios with strategies spanning the global markets, and see how they've performed against benchmarks. It's a great tool that I can use to find exciting opportunities before doing my own due diligence. For each stock, Investing Pro shows you a ton of information, all broken down in a way that makes it super easy to understand. Stock picking is a game won by turning over the most stones, and Investing Pro can help you find stocks others will have missed. The best part is, I've secured a special discount for you. Click the link in the description and get an extra 15% off your first Investing Pro subscription at checkout. The decades leading to the Great Depression were a complicated economic and political period for the US. European industries and agriculture had been devastated by the First World War, which had allowed US farming and manufacturing to thrive through exports to their trade partners. The US, which had consistently held very high tariff rates, began lowering them and even introduced an income tax as an alternative to raising government revenue. But as Europe bounced back in the 1920s, there was a growing oversupply of goods, particularly agricultural products. European markets that were importing from American farmers during the war were now buying from European farmers again. And even domestically, many US industries which had been booming suddenly had too many factories producing too many goods. So in 1922, the Fordney-McCumber Tariff Act was passed in an attempt to protect American businesses. It raised the average tariff rate on dutiable goods to about 40%, and was actually counterproductive to its goal of aiding domestic agriculture. The prices of crops, including cotton, corn, and wheat, continued to fall through the 20s, reducing the income produced by each yield. And at the same time, the prices of equipment surged. A harness set selling for $46 in 1918 was $75 by 1926. Farm wagons doubled from $85 to $150. The tariffs also invited retaliation from trade partners, with 26 European nations making major changes between 1925 and 1929. In 1927 and 1928, Australia, Canada, and New Zealand also raised tariff rates on the US. But all of this pain for American farmers was overshadowed for years because much of the US was experiencing an economic boom. The Roaring Twenties represented a period of rapid technological development and increased consumerism. The stock market was increasing at an incredible rate, and there was a growing sentiment that it would never end. Then came 1928, an election year. Republican Herbert Hoover campaigned on the promise of helping farmers who were continuing to struggle in the competitive global markets. He suggested raising tariffs specifically on agricultural product imports. By increasing the cost of importing wheat from Europe, for example, American farmers should be relatively more competitive. Herbert Hoover won the 1928 presidential election with a significant Republican majority in both the House of Representatives and the Senate. Within the first few months of his term, he followed through on his promise. A tariff bill sponsored by Senators Willis C. Hawley and Reed Smoot was brought to Congress, and in May 1929, the bill was passed by the House. To the public's surprise, the scope of the tariffs were significantly wider than what was initially proposed. This version changed tariff rates on about 2,000 different items. Rates on butter rose from 12 cents a pound to 14 cents, potatoes from 50 cents a pound to 75 cents, rates on wool and cotton clothing rose to 37.5%. All in all, the average equivalent tariff rate on agricultural products under the bill would rise from 40.3% to 54.2%. But it also raised tariffs on a lot of manufactured products, with the average rate on those rising from 34.8% to 38.6%. But this was just the beginning. The smoot-hawley tariff bill now needed to get past the Senate before becoming law. Lobbyists from all kinds of industries flocked to get their fingers on the bill, pushing for more tariffs to protect products in their markets. What began as a minor revision to help American farmers morphed into an all-encompassing shift away from free trade. When the bill finally passed the Senate, it changed import taxes on about 20,000 different products. Agricultural import duties jumped from 57.8% in 1929 to 91.8%. Textiles, clothing, shoes, machinery, and other manufactured goods saw rates climb, and the overall average rate on dutiable goods reached nearly 60%. The bill just needed a sign-off from President Hoover, and it would become law. A group of over 1,000 economists from across the US signed a letter to Hoover, urging him to veto the bill, to not let it become law. They warned that the tariffs would raise consumer prices, damage international trade relations, and ultimately force other countries to retaliate with their own tariffs. Some of the biggest business leaders at the time shared the same sentiment. Henry Ford, who at the time was revolutionizing the automobile production line and bringing affordable vehicles to the masses, was opposed to the tariffs. He even personally visited the White House, telling the president that the bill was an economic stupidity. Hoover ignored it all and signed the act into law in June of 1930. The stock market's reaction as these sweeping laws were passed paint a damning picture. The violent initial decline of the market began in late 1929. The Dow Jones Industrial Average peaked at 381 points before falling under 200 in less than 2 months. But what's interesting is that the market started to recover. Through the first half of 1930, the market rose more than 50%. Many investors believed that the proposed tariff rates were so broad, and in some cases nonsensically high, that it would ultimately be vetoed. But in May, when it became clear that this bill was going to become law, the market plunged, erasing all of the year's gains. And unfortunately for the world, it was only the beginning. The timing of the initial 1929 crash has led to the belief by some that it was triggered by sentiment around higher tariffs. I've been reading a lot of newspaper archives from the time, and they lead me to believe that it's very likely they at least played some role. But the truth is that the stock market was already in such a fragile state that any loss in confidence would have triggered the decline. Many industries in the late 1920s were setting profit records year after year, and so the stock market was experiencing a violent swing from the pessimistic lows of World War I to excessive optimism and euphoria. To make matters worse, stockbrokers were allowing everyday people to borrow huge amounts of money to buy stocks. And since prices just kept going up, investors became increasingly leveraged. And as is the case time and time again, it was the hot new technology companies that drew investment from everyday Americans. In the 1920s, it was radio companies like RCA, trading at stock prices that would only make sense if every household in the world needed 2 radios in every room. The market was a poorly constructed house of cards, and because everyone participating was loaded up on debt, as soon as prices began falling, everyone ran for the exit. But to me, a far more interesting question is what role high tariff rates played in the severity of the Great Depression. This wasn't just a spectacular stock market crash followed shortly by a recovery. America was devastated for years, and considering some of the eerie similarities between the 1920s and the 2020s, I wanted to understand why. After the 1929 crash, the US unemployment rate rose from about 3% to 25% by 1933, with an estimated 12.8 million Americans being out of work. Those fortunate enough not to lose their job saw their wages fall by over 40%. US GDP fell by nearly a third. Just to put that in perspective, the 2008 global financial crisis that rocked the world, the worst financial crisis in a century, GDP fell by less than 4%. The startling 50% decline in stocks looks like a joke when you zoom out over the following years. The Dow Jones Index fell to a low of 41 points, losing nearly 90% of its value from peak to trough. And it took 26 years for it to recover its losses. But specifically relevant to this conversation about tariffs is what happened to trade. With huge taxes now imposed on imports of 20,000 different items, it collapsed. Between 1929 and 1932, US exports fell from $7 billion to just $2.5 billion, with imports experiencing a similar decline. International relations soured between the US and its major trading partners, igniting years of trade wars. America's closest trading partner, Canada, hit back immediately with tariffs on 16 categories of US products, which made up about a third of US exports. Great Britain didn't initially retaliate, but in 1932 established the Imperial Preference System, which offered low tariff rates or duty-free trade to its Commonwealth partners like Canada and Australia. The United States was left out of this trade bloc, and Canadians were now buying from Britain and their domestic suppliers rather than America. Economists at the time and today are mostly in agreement that the Smoot-Hawley Tariff Act of 1930 exacerbated the Great Depression. A working paper from the National Bureau of Economic Research found that while production volume of manufactured goods recovered sharply from 1932, trade volume did not, which suggests that economies were beginning to recover, but tariffs prolonged the rebound of international commerce. Many countries were much more dependent on international trade than the US were, so the reduction in trade slowed their recovery and therefore slowed the amount of money flowing into the US from their imports. But worsening or prolonging isn't the same as saying that tariff policies caused the depression. In that discussion, tariffs are only considered a minor contributor. The first mainstream theory of the causes of the Depression comes from economist John Keynes. He argued that the Depression's onset and severity were largely explained by a spiraling decline in demand. After the 1929 crash, consumers were forced to reduce their spending and pay down their debts. The decrease in spending reduced demand for goods, and so businesses seeing lower profits were forced to lay workers off, thus creating a cycle of lower spending, reduced business investment, and higher unemployment. Classical economics at the time predicted that this cycle would eventually just settle on its own. But because the initial collapse was so severe, consumers just kept hoarding cash instead of starting to spend again. As wages and prices continued to fall, the incentive to save up cash simply increased. Why buy something today when it's going to be cheaper tomorrow? And borrowing money was incredibly risky because the real burden of debt goes up in a deflationary environment. Keynes' solution was for the government to step in and boost spending. The US didn't do this at the time, but today we see this strategy being used to reduce the severity of a crisis, most recently the huge government spending during the pandemic. Another mainstream theory for the Great Depression came from economists Milton Friedman and Anna Schwartz in 1963. They argued that the Federal Reserve failed to provide the banking system with the support it needed. The US faced a number of banking crises within the Depression period, with over 9,000 banks collapsing between 1929 and 1933. Insurance to protect customer deposits wasn't introduced until 1933, so every little panic caused a run on the banks. Banks are supposed to lend most of their deposits out, fueling the economy, but they were forced to hold huge reserves so that they had enough cash during these rushes of customer withdrawals. Friedman argued that the Fed could have acted as a lender of last resort, providing important liquidity to banks. Again, this is a core feature of the banking system today. In times of crisis, banks can borrow from the Fed at near 0% interest rates, making a prolonged collapse like the 1930s much less likely. I'm only really scratching the surface on some of these topics, so I'll likely explore them further in another video. A reminder to check out investing.com, click the link in the description to get an extra 15% off your first Investing Pro subscription. And thanks for watching.